Hi, my name is Ned Barrett. I'm the president of a digital marketing agency called Gray Matter Direct. In today's video, we're going to be talking about e-commerce profit and loss statements and financial planning. So get ready. When starting an e-commerce business, the very first thing that needs to be done is to create a financial roadmap for the enterprise. Without this roadmap, it's very hard for an e-commerce operation to get started, let alone thrive or even survive. The major elements that one needs to consider include creating a revenue forecast for your business, understanding your business's costs, creating profit and loss statements or P&Ls for the business, working with an accountant, and knowing that you're going to be constantly refining that plan as new information comes in. We are going to be discussing each of these in this presentation. The first step is to create a revenue forecast. The revenue forecast in this table is completely arbitrary and shows a steady doubling from $1 million in the first year of operation to $16 million in year 5. 100% growth for 4 years after a startup is fairly hard to achieve, as is generating the first $1 million in year 1 in any event. But it is a useful proxy for this illustration. The forecast is further broken down into 3 different brands or divisions. This is for companies who have multiple distinct brands or business units that are joined into a common forecast that shows how the different channels would combine together to create a total sales plan. You'll notice that we just arbitrarily created different sales levels for each one of these business units and assumed that one would be larger than the others. Many companies have only a single channel, but in case you had multiple brands, we wanted to show you this example. Then, by including metrics like the expected order value or average order value, $75 tends to be a common order value in e-commerce. You can estimate the number of orders your business will be fulfilling in a year or in a month. The above example assumes a constant number of orders each month. This is unlikely for most businesses that have seasonal variations. However, showing it this way allows you to ask questions about your company's ability to fulfill a certain number of orders in a given month. Sometimes a high order forecast will immediately cause you to wonder if your organization can handle the volume. We start the review of e-commerce P&Ls by selecting a revenue target. In this case, we will be evaluating a business with revenues of $1 million US. Although it was labeled as, we discussed this as being the first year of an operation, it could be any year. However, it's important to realize that all the numbers presented in this P&L discussion are pro forma in nature, and the actual numbers and percentages for a real business will be based on the dynamics of that particular business. So just, there's for everybody's business, there'll be different values for every one of these metrics. Now, just scrolling down, you can see that it's fairly complicated. Let's give you a little tour of this P&L. On the left-hand side over here is the full year P&L. Now, it's actually replicated in this column over here, column BS. Sorry for the BS part, but it's all good. The full year P&L is complemented by quarterly breakdowns. So we've got Q1, Q2, Q3, and Q4 of that business. Ideally, when you're creating a P&L, you're going to go even deeper and create monthly P&Ls that will summarize up to quarterly P&Ls. But that's a lot of work, and it's fairly complicated and requires a fairly deeper knowledge and a larger set of assumptions about what your business is going to do in any given month. So for this lesson, we're just going to keep it at the quarter and year level. Now, when we're talking about the $1 million example for gross revenues, this amount is generated by the goods and services that your company sells. And it is netted down by returns. That's the first thing that gets pulled out of your revenue forecast. We put in a value of 3%. Now, it's all over the board. It can be a very, very high percentage. Returns, if you think about the Home Depots of the world at a retail basis where a very large percentage of their the goods that go out flow right back in to be returned, and then new goods to be purchased. That's an extreme example, but I think it's common to it's safe to say that many businesses are going to see return rates in the mid single digits, and need to budget that against their initial gross revenues and know that they're going to have X amount netted down for returns. Now, another positive to the profit and loss statement is the shipping and delivery income, or shipping and handling. And, in today's e-commerce world, with the emphasis on free shipping, that may or may not be applicable to your business, but the cost to ship is baked in one way or another. I mean, it's going to cost you money it's going to end up costing you money. You're going to see that later in the P&L, to actually ship your goods to an end consumer. So, if there's periods where you are actually generating shipping and handling revenue, you've got to account for it. And those two things work to create, a total income where you've netted down returns and allowances. You've brought back in shipping and delivery income, and then you've got a total income line. And you can see in this example is 97.1%. I'm going to put a little filter on this so we can keep on seeing. Let's see, let's get that split up so that we can keep on seeing where we're at. Actually, I'm going to move that down and remove the split and add it back here, so we can keep on remembering what our revenue lines are as we go through each one of the phases. Now, the first major area of cost are the cost of goods sold. And that is your hard cost for the products in your warehouse. And again, depending upon your industry, it's going to be all over the place. It could be very, very low if you have a very high margin business, or it could be relatively high if you have a low margin business. But you have to have a healthy enough margin to support the rest of your P&L. So we put in 40% because it's in the mid zone of what we see with the manufacturers and companies that we work with. And that assumes that it's the fully loaded costs. Now, you can have entire divisions within your company costing out products. And at the firms I've worked at, there were entire costing divisions that would analyze from the materials costs to the labor and manufacturing costs, tooling costs, everything all the way up to getting that finished product put into a box and into your warehouse. Now, the one factor that's not included in there is the freight in. Depending upon where it's being manufactured, if it's being manufactured in China or overseas, you've got to account for containerized shipments into your distribution center or warehouse. And so that's why we've got 3.8% in there. Amazingly precise, but that's a value we're seeing for some of our clients today. And then the freight out is what I mentioned a few minutes ago, and that relates to how much it's going to cost you to actually get it into the hands of the end consumer. That's going to depend upon a variety of factors, including your contracts with UPS or FedEx or USPS or DHL, or wherever you're shipping your products out. But you've got to account for the fact that you're going to be shipping them out. And then the next and last major cost in cost of goods is warehousing, and we have that in at 5%. And warehousing includes the overhead. If you own your own facility, the cost that's being attributed to that facility within your P&L, because the goods sitting on the shelf have to absorb some of the cost for the overhead of the physical structure of the warehouse. It also includes pick, pack, and ship, where workers are going to pick that product off the shelf and place it in a box. And the attendant equipment and shipping labels and boxes and everything associated with it. So in other P&L exercises that we do, we'll actually break out all the different cost components for every different product line and blend them together to get to the things like the warehousing costs and the cost of goods sold and the other costs associated with cost of goods sold, like freight in, freight out. Again, they're blended because every product is going to be slightly different or majorly different, depending upon the case. And you've got to get down to a total cost of goods line that Could be as high as 55, 60%. Getting beyond 60, 65% gets really dicey in your ability to create a profitable P&L. So you want to, try to make sure that your costs are as lean as possible. Now, the corollary to that is that your retail pricing is going to be reflective of your base cost of goods. So obviously you want your retail price to be as aggressive as you possibly can make it, unless you're selling some kind of luxury good where price isn't a factor. But for most classes of goods, you're going to want to have that cost of goods low and the retail price appropriate so that you can maximize revenues. Once you take out and we're working off this total income line that's below the total gross revenue line. Once you take out your cost of goods, you're left with a gross profit of 44.3%. Now, I wanted to bring in at this stage that, remember, each one of these months is slightly different. We put 20% of the revenue in first quarter, 10% in second quarter, 30% in Q3, and 40% in Q4. And that's due to typical seasonality for a lot of the businesses we work with. Now, other businesses are completely reverse of that, but for the most part, consumer businesses operate on a Q3, Q4 basis where the majority of their sales are generated towards the end of the year. And that's important to note because you're going to have, when we get down into some of the other fixed costs, you're going to see that some of the fixed costs themselves force some months to be profitable and some months to be unprofitable. It's the blending of those that gets you to a profitable year that really, really matters. So then we're on that gross profit line, and we start to look at some of the expenses of the P&L. Now, the first one we're going to look at is advertising and promotion, which is near and dear to the heart of a marketer like myself. And again, as with cost of goods, there are many, many breakouts of the marketing costs and advertising costs. As we all know, the major categories are probably in an e-commerce business, social media, either management of the social media or the marketing that can come from social media, the paid marketing, web advertising in the form of Google AdWords, email marketing, affiliate marketing, YouTube marketing, and other advertising in general. Now you can throw in there direct response TV, regular TV, and any other costs you want, billboards, skywriting, it doesn't really matter, but this is where all of your advertising costs would go. And then you would have separate tables that would break out how those get spent, when they get spent, which particular vehicles, which particular email campaigns, which particular AdWords campaigns, with monthly budgets, and it gets very, very complicated very, very quickly. But what we're trying to do here is we're trying to show how much the business can endure in terms of advertising costs, because as we'll discuss in other lessons, advertising is a two-edged sword. You want to spend more to generate more clients, but you need to make sure that your P&L overall is profitable. And for many manufacturers throughout the years have considered a 6% advertising load in their budgets, and that's something that sort of is stuck with a lot of e-commerce businesses. It's typically below a 10% rate that fits in, but the key, as we'll learn, is that it has to fit into that P&L. It's not an arbitrary amount. It's basically advertising, it can be sometimes considered to be the very last cost added, whatever fits into the P&L based on what after you've determined what your profitability is going to be and all the other costs, then you figure out what your marketing costs are. Now, going down a little bit more, you've got things like computer and internet expenses. Now, for some of us are running business through the marketplaces of major retailers, so that there are costs in terms of EDI setup fees, and then just general computer and internet expenses that are unrelated to marketing. And you could toss in website upgrades, hosting fees, those kinds of things into this. So we put it in like 3% for that, which is fairly common. And then we've got insurance expenses, and everybody should have general liability insurance, and it depends upon your particular policy and what you're doing, but we put in 1% for that. And now we get to some of the interesting stuff, salaries. Now, as with the other sections we've mentioned, salaries have multiple components of cost. You've got the raw wages for the employees and salaries, and then you've also got things like health insurance. You've got travel. The travel comes in later, but you have other attendant costs. But it's really critical that you sit down, look at the employee plan, and figure out what everybody's getting paid, when they're getting paid, when the bonuses are happening, and figure out how that's going to fit into your P&L. And you see we've got 4 employees here at different salaries, and every organization is going to be different in terms of the distribution of high and low price salaries. And in this P&L, we've got 21.5%. Now, in the next section, we've got quote-unquote other expenses. And these are things that really this list could be quite long. It could be 20, 30 items in this list, but we just kept it down to some of the more common ones. Many organizations will have a couple of consultants hanging around, and they've got to get paid. You've got some very minor fees that should be accounted for, but all those minor fees really add up. You've got dues and subscriptions, licenses and permits. When you get internal meals and entertainment for sort of what's going on in the office as opposed to external travel. Internal office supplies, postage and delivery, and these are really very, very modest. And professional service, professional fees, maybe your accountant, those kinds of fees, lawyer would fall under that. So we have 4.5% overall associated with those fees. And then for companies that have trade shows, and many of us will be going to trade shows, especially manufacturers in every category. So you've got to account for the expense of a booth, the fixtures at the show, some miscellaneous supplies. If you own if you have to purchase it, it could be much more expensive than this, and depending upon, some of the booths I'm familiar with, it could be millions of dollars, it could be very modest, but it's got to fit your P&L. Remember, we're working on this $1 million P&L, so we've got 2.2% in here. And then we've got the true T&E, or travel and entertainment expenditures. We've got airfare, hotels, and transportation. We're trying to keep it a little bit modest here because it is a smaller company. And so we got 1.6% of the budget associated with that, or $16,000. Really not a lot of travel and entertainment, but probably just enough to get out to the shows and get to visit clients and prospects. So when we wrap all this stuff up, we come down to a total expense line, $398,000. And remember, what we're doing is we're going back up to this P&L. We've got our gross profit. So that gross profit is what we've got after the cost of goods and all that other stuff. And then we take that $442,800 and we net down to $398,000. We've got an income of $44,500, and that's 4.5%. And that's a modest mid-range profitability for a firm. Now, knowing that this firm is in its first year of operation, or assuming that it's in its first year of operation, that is really good, because many businesses really have to invest to get started and will lose money in their first year, even their second year. So assuming a 4.5% profit in year one is actually pretty darn good. But over time, as that revenue grows, you're going to want to see that profitability go up into the high single digits, into the mid double digits. Some businesses are extraordinarily profitable, others are less so. One argument to be made is that if you're extraordinarily profitable, then you should be running some of those costs back into your advertising and research and development to try to grow your business more. So there is this sort of sweet spot in the teens possibly, or maybe upwards of 20%, but not too much higher, where you want to please shareholders and also create profit for your investors, but also recognizing that getting too profitable, unless you're just one of those rare companies that just can print money, it's important to reinvest in your business. And again, looking at this revenue flow is where it really highlights where the profitability comes in. And Q1 at $200,000, the fixed costs militate to create a loss. And in Q2, it's even more significant loss because we're down to $100,000. But then in Q3, it starts to pick up and we get a 10%. And then in Q4 is when we really start to take off. Remember, even though these percentages are bigger, they're smaller numbers because of the smaller revenue base. And that's how we get to our $44,500 profit for the first year of this company. There's much more to discuss. I'll be discussing it in future lessons, but we really appreciate you taking time to listen to this video. And if you have any questions, please reach out to us. The website is graymatterdirect.com, and my name is Ned Barrett. Thanks so much.